Welcome to Live to Rise, your online Ask a Mentor channel. This video has been prepared in response to the request raised by Asiya. Thank you, Asiya, for your wonderful question. In today's video, we shall discuss two types of lease: operating lease versus financial lease. A financial lease transfers the asset and any risk or return to the lessee. This means that ownership is transferred in a financial lease to the entity that leases the asset. In an operating lease, the ownership remains with the lessor, the entity that leased the asset to the lessee. Let's draw a comparison between operating lease and financial lease. How does ownership of assets work in both cases? Well, in an operating lease, the lessor retains ownership throughout the lease term. However, in a financial lease, the lessee gains ownership rights over the asset for a substantial portion of its useful life or economic life, often resulting in the transfer of ownership by the end of the lease term. How do we officially account for them? Operating leases are treated as off-balance sheet items. Lease payments are recognized as operating expenses on the income statement. On the other hand, financial leases are recognized as both an asset and a liability on the lessee's balance sheet. The asset is recorded at its present value, and periodic lease payments are split between interest expense and reduction of the lease liability. What about the duration and terms? In operating lease, typically, shorter-term leases are applicable, where the lessor retains the risks and rewards of ownership. These leases often have cancellation options and are more flexible in nature. However, in financial lease, these are generally long-term leases where the lessee assumes most of the risks and rewards of ownership. These leases often cover the major part of the asset's useful life, otherwise economic life, and may include terms such as maintenance responsibilities and purchase options at the end of the lease term. Do they have tax benefits? Lease payments are fully deductible as operating expenses, providing tax benefits in the case of an operating lease. Whereas in a financial lease, since the lessee is considered the owner of the asset for tax purposes, they may be eligible for tax benefits such as depreciation reductions and interest expense reductions. Let's take an example in each case. Imagine a company leasing office space for 2 years. The lessor owns the building and leases it to the lessee. The lessee pays a monthly rent, which is expensed on the income statement. At the end of the lease term, the lessee can choose to renew the lease, relocate, or simply walk away. This is therefore an operating lease. Let's take another example. Consider a company leasing manufacturing equipment for 5 years, like a machinery or JCB. The lessor purchases the equipment and leases it to the lessee for the entire useful life of the asset, even for cruiser ships, container vessels, helicopters, or aircrafts. The lessee records the equipment as an asset and a corresponding liability on their balance sheet. They make regular lease payments, which consists of both principal and interest portions. At the end of the lease term, the lessee may have the option to purchase the equipment at fair market value. This is a financial lease. I would strongly recommend you drawing a comparison chart to differentiate between operating and financial lease. Happy learning!